Hi friends, good morning all. Welcome back to CAP classes. In this video lecture, we are going to discuss about accounting standards. So you know the significance of accounting standards, you know the weightage of accounting standards in the professional examinations, whether it is CA, CWA, ACCA, CMA, US or any other course. So the accounting standards they form very vital part of accounting and they discuss about so many important things. So in this video, we are going to discuss about one, what are accounting standards? And two, who will issue accounting standards? And three, why accounting standards are required? And four, how many accounting standards are there at present? So in this video, we are going to discuss about accounting standards and we are in specific going to discuss about what are accounting standards, who issue accounting standards, why accounting standards are required and how many accounting standards are there. So to begin with, first one is what are accounting standards? Accounting standards are written policy documents. Accounting standards are written policy documents issued by various authorities. And these authorities are A. Central government. Central government can issue accounting standards with the support of regulatory authorities. And usually in many countries, it is also customary that professional accounting bodies like ICAI, professional accounting bodies like Institute of Chartered Accountants of India, AICPA. Like this, professional accounting bodies also issue accounting standards. So to begin with, point number one, accounting standards are written policy documents issued by central government with the support and help of regulatory authorities and professional accounting bodies. And the second point is what accounting standards deal with. Accounting standards deal with four major issues. Accounting standards deal with the following. There are four major things. And they are, first one is recognition of events and transactions. Recognition of events and transactions. So if you are accountancy student, since you are +1, that means the day you joined your 11th class, you might have listened or read this word recognition so many times. What is the meaning of recognition? Recognition means at what point of time? At what point of time? That means when a transaction can be recorded in the books of account. Recorded in the books of account. So recognition simply means when a transaction can be recorded in the books of account. Now simple. In other words, easily we can say that when a journal entry can be passed. When a journal entry can be passed for a given transaction. When a journal entry can be passed for a given transaction. Now you know that when you pass a journal entry, the journal entry may result in recognition of an asset. The journal entry can be recognition of a liability, or it can be recognition of revenue or income we call, or it can be recognition of an expense. So for this, let us understand, let us consider some examples. One, you have sold goods on credit. When you have sold goods on credit, you pass a journal entry, debtor account debit to sales account. Debtor account debit to sales account. And the second one is, another example what I'd like to give you here is, you purchased a fixed asset, then you will write the entry fixed asset account debit. If you have paid cash, you'll write cash, or if you have not paid cash, you'll write supplier account, which is creditor. So I have given you two journal entries. One is a journal entry for sales. Second one is a journal entry for purchase of an asset. Now the question is, I have paid 1 lakh rupees of advance to procure an asset. So when I have paid 1 lakh rupees, can I pass a journal entry? That is the question. If I pass the journal entry, should it be advance given for procurement of an asset, or should it be fixed asset procured? So what should be the journal entry? So my dear friends, when we discuss about, say for example, procurement of an asset. So you purchased an asset. When a journal entry can be passed? Now consider two things. One, what is the journal entry that is to be passed when you purchase a fixed asset? Can I say the journal entry should be fixed asset account debit to cash account? Imagine that you have paid cash, or maybe if you have not paid cash, it will be supplier account. So you'll pay it later. So here amount will be there. Debit amount, credit amount. Now it is simple. When this journal entry can be passed? When this journal entry is to be passed? This is recognition. Having said that, at some point of time this journal entry can be recorded, then the question arises, with what amount this journal entry is to be passed? With what amount this journal entry is to be passed? This is called measurement. For example, you have purchased this asset, say for example for 1 lakh rupees. Asset cost is 1 lakh rupees. You know, there is one principle. All the incidental expenses, directly attributable costs. For example, transportation. For example, non-refundable taxes paid. For example, transit insurance. For example, installation. Test run or trial run, what we call. All these things can be capitalized. So this 1 lakh rupees plus certain things. And also, if you go through the accounting standard, it clearly says that there are certain expenses which cannot be capitalized. So these accounting standards will tell you when a transaction can be recorded, that is recognition, and at what amount this transaction is to be recorded for. This is called measurement. So step 1, accounting standards deal with recognition. This is one. Step 2, accounting standards deal with measurement. And I told you there are 4 major things accounting standards deal with, and I told you there are first 2 are recognition and measurement, and the third one is presentation of transactions and events. Presentation of transactions and events. Presentation of transactions and events. It is something like this. Say for example, I have purchased asset with 100 rupees. Cost of asset is equal to say rupees 100. And then I received a government grant. Government has given me 40 rupees. Now what am I supposed to do? Should I present the asset? See, this is my balance sheet. Should I present my asset, fixed asset, is it 100 rupees? Or no, 100 is wrong, 60. So how to present this? So should I take gross in the inner column minus government grant, and should I put net in the outer column? Or alternatively, should I prepare my balance sheet like this? Fixed asset is 100 rupees because 100 rupees is the cost of fixed asset I have procured. And should I write the government grant as a deferred income under the liability side for 40? This is called net approach. This is called gross approach. So how a transaction is to be presented? These kind of issues also accounting standards will take care. And then comes the fourth major important thing. Accounting standards also deal with disclosure requirements. Disclosure requirements. I'll give you two examples for this disclosure requirement. First one is earnings per share. As per accounting standard 20 or Ind AS 33 or international accounting standards 33, earnings per share is to be given on the face of P&L account, on the face of statement of profit and loss. So this is one disclosure requirement. Second one is notes to accounts. In notes to accounts, we give the disclosure of significant accounting policies. Significant accounting policies. So accounting standards will guide how these disclosures are to be made also. So in a nutshell, what is the summary? Accounting standards deal with 1. Recognition of transactions and events. 2. Measurement. 3. Presentation of various items. Presentation of transactions and events in financial statements. And 4. Disclosure requirements. Fourth one is disclosure requirements. So this is part 1. Part 2, why accounting standards? Why accounting standards? Now it is practically impossible for any country to adopt a single set of accounting policies. Single set of accounting policies can never be followed. So this is something like dictatorship. You cannot say only this is allowed. So usually they give more options. So though we standardized various accounting treatments, still we will have more than one option. So the accounting standards standardize diverse accounting policies with a view to eliminate non-comparability of financial statements and thereby improving the reliability of financial statements to maximum possible extent. And also accounting standards provide a set of standard accounting policies, valuation norms and disclosure requirements. So accounting standards standardize. Accounting standards standardize diverse accounting policies. Say for example, imagine there are two companies. This is X Limited, this is Y Limited. So X Limited buy closing stock in their P&L account. Y Limited in their P&L account. They have written closing stock 100 rupees or say 100 crores. This company has written buy closing stock 120 crores. So imagine this is finished good named A 10,000 tons which is valued at 100. Imagine this is also finished good A 10,000 tons only and this is valued at 120 because this company follows one method FIFO and this company follows another method. This company follows FIFO and this company follows weighted average method. So if you observe, quantity wise both of them are same, but value wise both of them are not same. So on same day 31/3/2018, when they are preparing their financial statements, despite the fact that the quantity of closing stock, the nature of goods and exactly they are same in two godowns of two different companies, but still one company is valuing them at 100 crores, another company is valuing them at 120 crores. So obviously this P&L will show an increased profit of, here profit will be more by 20 crores. But that doesn't mean Y Limited is more efficient than X Limited. It is just a change in accounting policy. So what you need to understand is this 20 crores profit is not earned. That means Y Limited is in no way better than X Limited. So when you are doing performance appraisal, you need to give much weightage to these kind of things. So how a user of financial statement who is comparing X Limited and Y Limited P&Ls, profit and loss accounts, how he comes to know that Y Limited profit is 20 crores more, not because of the performance of Y Limited, but it is just because of an accounting policy. This is to be disclosed. Unless this is disclosed and controlled by one accounting standard, users will take wrong decisions. So, accounting standards standardize diverse accounting policies. Friends, we are discussing why accounting standards are required. We are discussing why accounting standards are required. If accounting standards are not there, what will happen? In that, I told you accounting standards are required because there are diverse accounting policies that are to be standardized. Now, what is the advantage of this standardization? The advantage of this standardization is it eliminates non-comparability. It eliminates non-comparability. So when it eliminates non-comparability, obviously financial statements are more reliable because you are disclosing all the accounting policies. And the second one is accounting standards provide a set of standard accounting policies. Accounting standards provide a set of standard accounting policies, standard valuation norms, and standard disclosure requirements. So the advantages or the necessity of accounting standards is that accounting standards standardize diverse accounting policies. There are two advantages of standardization. First one is it eliminates non-comparability, and by eliminating non-comparability, it improves the reliability of financial statements to the maximum possible extent. And the second advantage of this accounting standard standardization is that it provides a set of standard accounting policies and standard valuation norms and standard disclosure requirements so that the user of financial statements will take informed and correct decisions. So we have discussed about what are accounting standards. I told you accounting standards are the written policy documents. And step 2, I also told you who issues accounting standards. I told you accounting standards are issued by central government with the support of regulatory bodies. And 3, I also told you what accounting standards deal with. They deal with recognition, measurement, presentation and disclosure. And also I told you what are the advantages of accounting standard standardization. That means comparability, and it provides standard accounting policies, valuation norms and disclosure requirements. And the last phase is how many accounting standards are there. How many accounting standards are there in India now? See, ICAI totally issued 32 accounting standards. ICAI totally issued 32 accounting standards. But out of 32 accounting standards, accounting standard 6, which is depreciation accounting, is merged with new accounting standard 10. So this has become property, plant and equipment. This has become property, plant, equipment. So previously accounting standard 6 deals with the depreciation. Previously accounting standard 10 deals with fixed assets. So old accounting standard 6 depreciation, old accounting standard 10 fixed assets accounting. This two put together has become new accounting standard property, plant and equipment. So here if you observe, there is one accounting standard which is reduced. And there is accounting standard 8 research and development cost. Accounting standard 8 research and development cost. This also is deleted because this is merged with accounting standard 26 intangible assets. Because research and development cost finally will result in some patents or some technology or some intellectual property right. So it is appropriate to merge this research and development cost with intangible assets. So accounting standard 8 is deleted. This is the second standard which is deleted. And then series of 3 standards, accounting standard 30, accounting standard 31 and accounting standard 32. These are financial instruments. These are financial instruments. Though ICAI issued them long back in 2009, they were never notified by Ministry of Corporate Affairs. So there is no legal sanctity for this accounting standard 30, 31, 32, and recently ICAI withdrawn them. Because the new generation accounting standards, what we call popularly Ind AS, they released Ind AS 32, Ind AS 107, Ind AS 109 to substitute this old three standards financial instruments. So my dear friends, here one accounting standard is deleted, here second accounting standard is deleted, here 3, 4 and 5. So total 5 standards are deleted. So out of total 32 standards, when you subtract these 5 standards which are deleted, so today practically 32 minus 5, there are 27 accounting standards. So originally 32 standards were released. From that 5 standards are deleted. So total today in India we have 27 accounting standards. These are first generation, that means old accounting standards. And there are new accounting standards released which are Ind AS, which are applicable now for final. They are not yet applicable for CA intermediate level. So my dear friends, total there are 27 accounting standards in existence.